Welcome to the deep dive. Today we're really zeroing in on something specific and, let's be honest, often pretty complex. We're talking about how trusts get taxed.
Hmm.
We've got this great source document to guide us. It really lays out the core mechanics. And our mission really is to take this technical stuff and, make it make sense.
Yeah, unpack it a bit.
Exactly. We'll unpack key concepts. You hear these terms thrown around, like grantor trusts, simple versus complex trusts, trust accounting income, D&I, which sounds mysterious.
It does a bit, yeah.
And we want to help you understand who actually pays the tax bill when a trust is involved. Is it the trust? Is it you, maybe, as the beneficiary? That's what we're digging into.
And trust taxation, it definitely has this reputation for being intricate and, well, rightly so in many ways.
Yeah.
But the document we're looking at, it does provide a pretty clear path through that complexity. Understand these fundamental principles it outlines. It's just essential if you might be a beneficiary or maybe you're involved in setting up or managing a trust. We're going to break those down step by step.
Okay, good. So let's start right at the beginning, just like our source does. What is a trust exactly in this whole tax context?
Right.
The source defines it as a separate legal entity. So think of it like, I don't know, a mini company. Or maybe a distinct box created under state law.
Yeah, that's a good way to put it. Its main job is simply to hold and manage property. Assets, investments, real estate, cash for the benefit of other people.
Okay.
And to make this box, this entity, work, you need specific roles.
Yeah.
Our source clearly defines these. First up, you've got the grantor,
Grantor.
sometimes called the settler or a creator.
Yeah.
This is the person who actually decides, hey, I'm setting up this trust. They're the ones transferring their own property
Right.
into this new legal structure.
Got it.
And that property itself, that's often called the trust corpus or the principal.
So grantor initiates, puts the assets in the box. Simple enough so far.
Exactly. Then the grantor appoints a trustee. Now, this could be an individual, maybe a family member, a friend, or it could be a professional entity, like a bank's trust department or a dedicated trust company. Okay? The trustee is the fiduciary. They're the manager. They actually hold the legal title to the trust property, and they are legally bound, this is important, to manage and administer those assets strictly according to the instructions laid out in the trust agreement.
So they have rules they have to follow.
Absolutely. Their main job is always to act in the best interest of the beneficiaries.
Okay, so the trustee is the one actively, running the show day to day, managing the investments, paying bills, handling things.
Precisely. And then, finally, you have the beneficiary, or often multiple beneficiaries.
Right.
These are the people, or maybe charities or other entities named in the trust agreement, who are supposed to benefit from the trust property or the income it generates. They are the whole reason the trust was set up in the first place.
Okay, so let's recap. Grantor puts stuff in, trustee manages the stuff based on the rules, beneficiary gets the benefit from the stuff. The structure seems, well, relatively straightforward on the surface.
It is, at a high level.
Yeah.
But the tax piece immediately adds that layer of complexity we talked about. Our source highlights this right up front. That trust principle, those assets put into the box, they can generate income every year. Interest, dividends, maybe rent from a property or capital gains if assets get sold. The fundamental question for tax purposes becomes, who is going to report that income and ultimately pay tax on it? Does the tax liability stay with the person who originally put the assets in, the grantor, or does it somehow pass through to the people intended to benefit, the beneficiaries? Or does the trust entity itself have to pay the tax?
That pass-through idea sounds key.
It's absolutely central to understanding how trust taxation works, this question of who pays the tax.
And that leads us right into how the IRS first starts sorting these trusts out for tax purposes. Our source breaks them down into two main types. What's the first big bucket?
Okay, so the first main category for tax purposes is what's called the grantor trust.
Grantor trust.
And the document defines this based on a pretty simple principle, actually. It's when the original creator, the grantor, has held on to or retained certain powers or a significant degree of control over the property they put into the trust. They haven't fully let go.
What kind of control are we talking about? Does the source give examples? Because control can mean a lot of things.
Yes, it does. It lists key retained powers that would trigger this grantor trust status. So these include things like the power for the grantor themselves to take the income out of the trust,
Okay.
or the power to borrow money or assets from the trust without, say, adequate interest or security. Or, a big one, the power to change who the beneficiaries are, or maybe change how much they receive.
Ah, so if the grantor keeps that kind of influence, keeps their fingers in the pie, so to speak.
Exactly. If they keep too tight a grip, the IRS basically says, okay, look, for tax purposes, we're still treating this property as yours.
And if the IRS treats it as the grantor's property, what does that mean for taxes? What's the bottom line?
Well, this is the core point about a grantor trust.
Hmm.
It is not recognized as a separate tax-paying entity for federal income tax purposes.
Not separate. Okay.
It doesn't have its own independent tax life, you could say.
So wait, does that mean it doesn't file its own tax return like maybe other trusts do?
That's exactly right. And the reason, as the source explains, is because of those powers the grantor kept. The assets are still effectively seen as belonging to the grantor.
Got it.
So all the income generated by those trust assets, any interest, dividends, capital gains, and also any related expenses or deductions, they just pass directly through to the grantor.
Directly to the person.
Directly. They get reported on the grantor's personal income tax return, their Form 1040, basically as if the trust didn't even exist from an income tax standpoint.
Wow.
And this is true regardless of whether the income is actually kept inside the trust structure or if it's paid out to beneficiaries. The trust itself doesn't file that main fiduciary income tax return, the Form 1041.
Okay, now here's something I think is really interesting and probably relevant to a lot of listeners. Our source points out that a very, very common type of trust, one many people use for basic estate planning, actually fits this grantor trust definition. That's the revocable living trust.
Absolutely.
We hear about these all the time as alternatives to wills. So how do those work and why are they typically grantor trusts?
That's a great point.
Yeah.
The source explains that individuals often set up these revocable living trusts during their lifetime. It's a way to manage their assets while they're alive and also plan for how those assets get distributed when they pass away, often helping to avoid the probate process.
Right.
Now, the key characteristic that makes it a grantor trust is right there in the name, revocable.
Revocable, meaning you can change it?
Exactly. The grantor maintains the power to amend the trust agreement, change beneficiaries, change trustees, or even completely revoke the trust altogether and take all the assets back.
Ah.
They also typically keep the right to receive all the income from the trust assets during their lifetime. Because the grantor keeps this fundamental control, this access to the assets and the income, the IRS views it as if, for tax purposes, the grantor never really gave up ownership.
Makes sense. If you can take it back anytime, it's still kind of yours.
Precisely. Therefore, while the grantor is live, all the trust's income is just reported directly on the grantor's personal Form 1040.
Okay, so the big takeaway for a grantor trust, like that common revocable living trust, at least while the grantor is alive, is that the tax burden stays completely with the person who created it. All the trust income goes on their personal return.
Exactly. For the trust entity itself, it's basically a tax non-event.
Okay, so if grantor trusts tie all the income back to the creator, what's the deal with the other main category, the trusts that aren't grantor trusts?
Right. So the other major category is, logically enough, the non-grantor trust. And this is pretty much the opposite scenario. The source clearly states that a non-grantor trust is treated as a separate tax-paying entity by the IRS. This happens when the grantor has given up sufficient control over the assets and the trust terms. The trust now has its own tax identity.
This is where the trust itself might actually owe taxes, right? That sounds like a really big difference.
That's a fundamental shift, yes. For a non-grantor trust, the income it earns can be taxed in one of three ways. Either entirely to the trust itself, or entirely to the beneficiaries, or split somehow between them.
Split, okay.
And the document explains that figuring out how that split happens is really the core mechanic we need to wrap our heads around. It depends on several factors, like how much income is actually distributed out to beneficiaries that year, what kind of income the trust earned, like interest versus capital gains, and, importantly, whether the non-grantor trust is classified as a simple trust or a complex trust.
Simple or complex. Okay, another layer. And unlike grantor trusts, these non-grantor trusts, they do have their own filing requirements, I assume.
Oh, absolutely. Non-grantor trusts have to file their own annual fiduciary income tax return. That's Form 1041.
41, okay.
This return is where they report all the income the trust earned during the year. And crucially, when they make distributions of income to beneficiaries that are considered taxable to those beneficiaries, they report the details of those distributions on something called a Schedule K-1. A copy goes to the beneficiary and another copy goes to the IRS.
Schedule K-1. So
Yeah.
that's like the trust version of a W-2 or a 1099 that you'd get. It tells the beneficiary what income they need to report.
That's a perfect analogy, yes.
Yeah.
The K-1 breaks down the income attributed to the beneficiary.
Okay, so the non-grantor trust files its own 1041, reports all its income, then it figures out how much tax it owes versus how much gets passed out to the beneficiaries to be taxed on their returns, and it reports that pass-through amount on the K-1. Precisely. And the core tax principle here for non-grantor trusts, the real bedrock concept, is this. Income that is distributed to beneficiaries, or in some specific cases, income that is required to be distributed, even if it wasn't paid out yet, that income is generally taxed to the beneficiary who receives it or is supposed to receive it.
Okay.
Income that is retained by the trust, income that's not distributed, is generally taxed to the trust itself.
Got it. Distributed income tax to beneficiary, retained income tax to trust.
That's the essence of the pass-through concept in the non-grantor world. Income passes through to the beneficiary rather than staying with the trust, but only up to certain limits, which we'll definitely get into.
Okay, so the non-grantor world is all about splitting that tax liability between the trust and the beneficiary. And our source says a key step in figuring out that split is classifying the non-grantor trust. It's either simple or complex. Why does that distinction matter so much?
Yeah, this simple versus complex classification, it's really crucial because it dictates the rules around mandatory distributions, and that, in turn, directly affects how the income gets taxed and to whom.
Okay.
The source gives us 3 specific requirements. A non-grantor trust has to meet all 3 of these requirements to be considered a simple trust for tax purposes in any given year.
All 3. Okay, that sounds strict. What's requirement number 1?
First, the trust agreement itself must require the trust to distribute all of its income to the beneficiaries annually.
All of its income.
Yes, but the source adds a really vital clarification here. When the tax code says income, in this specific context, it means trust accounting income, usually abbreviated as TAI.
Key AI. Okay, not just any income.
Right. It's a specific definition of income, often different from taxable income. We're going to dive deep into TAI in a minute, but for this simple trust rule, it basically means the trust has to empty its TAI bucket each year and give that amount to the beneficiaries. No holding back TAI.
Okay, rule 1. Must pay out all the TAI every single year. Got it. What's the second rule for being a simple trust?
Second, the trust agreement cannot permit distributions from the trust principal, also called the corpus.
Ah, so you can't dip into the original pot of assets.
Exactly. The trust can only distribute the income it earns, the TAI. It can't make distributions out of that initial capital that was put into the trust.
Don't touch the capital, only distribute the earnings. Makes sense. And the third requirement.
Third, the trust cannot make any contributions to charitable organizations during that year.
No charitable gifts. Okay. So, let me see if I have this right. A simple trust is a non-grantor trust that 1. has to distribute all its TAI each year, 2. is forbidden from distributing principal, and 3. doesn't give to charity. It sounds quite, well, simple but also restrictive.
It is quite restrictive. Simple trusts are really designed just to act as a conduit, to pass current income through to the beneficiaries each year.
Oh.
The source then defines a complex trust. Very, well, simply. It's basically any non-grantor trust that doesn't meet all 3 of those simple trust requirements in a given year.
So if a trust fails even one of those tests, it becomes complex for that year.
Correct.
Like if it's allowed to keep some income instead of distributing all the TAI, or if it can distribute principal even if it doesn't, or if it can give money to charity.
Yes. Any one of those conditions being met flips the switch to complex for that tax year. If it doesn't distribute all TAI, or if it does make a distribution from principal, or if it does make a charitable contribution, it's complex. And this is a key nuance the source highlights. A trust's status isn't necessarily set in stone. It can change from year to year.
Really? How does that work?
Well, imagine a trust is drafted with some flexibility. Maybe the trustee has the option to distribute principal or has the option to accumulate some income instead of distributing it all. In year 1, let's say the trustee only distributes a current TAI and makes no principal distributions or charitable gifts. For year 1, it could qualify as a simple trust. But maybe in year 2, the trustee makes the required TAI distribution and also decides to make a discretionary distribution of principal to help a beneficiary buy a house. Or maybe the trustee decides to hold on to some of the TAI for future needs. In year 2, because it either distributed principal or didn't distribute all TAI, it becomes a complex trust.
Ah, so its tax classification can actually change year to year based on what it actually does or what its rules allow it to do?
Exactly, based on its operations and the terms of the trust document.
Yeah.
You can't just label a trust simple or complex when it's created and assume it stays that way forever.
That year-to-year variability is fascinating. It means you really have to look closely each year. And I assume this distinction matters a great deal for the actual tax calculations, which is where we're headed
It
next.
absolutely does. Before we can even start figuring out how much is taxed to the trust versus the beneficiary, our source says we need to calculate this thing called trust accounting income, or TAI.
Right, TAI. We mentioned it's the basis for that simple trust distribution rule. What exactly is it? How is it different from, say, regular taxable income?
TAI is often described as the book income of the trust. Think of it as the trust's internal accounting measure of income.
Okay, book income.
It's calculated based on the specific rules laid out in the trust agreement itself, and also the default rules provided by the relevant state law where the trust is administered. Critically, it's not initially calculated using federal tax rules.
So it's the trust's own definition, or the state's definition, of what counts as income that's available for distribution, separate from what the IRS might call taxable income.
That's a great way to put it. Its primary purpose, as the source states, is to figure out that amount that must be distributed annually, especially for simple trusts. But it also pops up later in the tax calculations for both the trust and the beneficiaries, as we'll see.
And the source gives rules for how the trust's various receipts and expenses get sorted, right? Allocated either to the trust's permanent capital, principal, or corpus, or to this annual income figure, TAI.
Yes, it details the standard allocations. Generally, most regular ongoing income items and typical operating expenses get allocated to TAI.
Okay.
This includes things like operating income and expenses from, say, a rental property the trust owns. Interestingly, the source specifically mentions depreciation expense being allocated to TAI.
Depreciation, that sounds like a tax concept.
It is, but here it's used in calculating the book income, TAI. Also allocated to TAI are things you'd expect: taxable interest, tax-exempt interest, dividends, rents, royalties, basically, the revenue stream generated by the principal assets.
So the stuff you'd normally think of as annual earnings, that generally lands in the TA bucket,
Correct. Now, what's typically allocated to the principal, or corpus, are items that represent changes in the fundamental value of the trust assets themselves, rather than a recurring income stream.
like selling stock.
Exactly. The source lists capital gains and losses that result from selling trust assets. Also, things like casualty gains or losses. These affect the overall size of the principal pot, not the amount legally defined as distributable income, TAI.
That makes intuitive sense. If the trust sells stock for a big profit, that increases the total value, but it's not like getting a regular dividend payment that the trust might be required to pass on as TAI.
Precisely. Then you have administrative expenses, things like trustee fees, legal fees, accounting fees. The source says these get allocated between principal and TAI according to whatever the trust agreement says.
And if the agreement doesn't say anything,
Instead, law provides the default allocation rules, and often, as we'll see in the example, that involves splitting them somehow between the two.
Okay, this seems like a good time for an example. Let's use the source's example 1, the Wells Trust, to walk through calculating both TAI and the ending principal value. It's set up as a simple trust, with Daniel as the sole beneficiary. The starting principal is $300,000.
Okay.
And for a year, the trust had $3,000 of tax-exempt interest, $5,000 of taxable interest, $5,000 of dividends, a $10,000 capital gain from selling stock, and paid $6,000 in trustee fees. The trust agreement specifies that those trustee fees are split evenly, 50-50, between principal and TAI.
All right, let's follow the source's calculation from example 1. First, let's figure out the ending trust principal, corpus. We start with the beginning principal, $300,000.
$300.
Capital gains of $10,000 are allocated to corpus, so that increases it. We add $10,000.
Okay, plus 10K.
The trustee fees are $6,000 total, split evenly. So $3,000 is allocated to principal. Administrative expenses like this reduce the principal value, so we subtract $3,000.
Okay, so start with $300,000, add $10,000 for the capital gain, subtract $3,000 for the principal share of the fees. That gives us $307,000 for the ending principal. It grew a bit.
Correct. The principal increased to $307,000. Now let's calculate the trust accounting income, TAI, for the year. We need to gather the income items allocated to TAI. That's the $3,000 tax-exempt interest, the $5,000 taxable interest, and the $5,000 dividends.
Right, but not the capital gain because that went to principal.
Exactly. Capital gains are excluded from TAI in this case. Now, we also need to account for the expenses allocated to TAI. That's the other half of the trustee fees, the other $3,000. Expenses allocated to TAI reduce it, so we subtract $3,000.
Okay, so $3,000 tax-exempt interest plus $5,000 taxable interest plus $5,000 dividends, that's $13,000 of income items, minus $3,000 TAI's share of trustee fees equals $10,000. So the trust accounting income, TAI, for the Wells Trust this year is $10,000.
That's it. $10,000 is the TAI, and the source emphasizes the crucial consequence because this is a simple trust. It must distribute this entire $10,000 of TAI to the beneficiary, Daniel, for the year.
Ah, right, because it's simple. That $10,000 is the amount legally required to be paid out based on the trust's definition of income.
Exactly. That link between TAI and the required distribution for a simple trust is fundamental.
Okay, so $10,000 is the book income, TAI, and for a simple trust, that's the distribution target. Now, let's step away from the trust's internal books and get back into the IRS's world. How do we figure out the trust's taxable income, specifically before we account for any of the distribution going out to Daniel?
Right. This next step is calculating what the source calls trust taxable income before income distribution deduction. This is essentially the trust's raw taxable income generated during the year before it gets that special deduction trusts receive for distributing income.
Okay, how do we calculate that?
You start by adding up all the trust's gross income items that are actually taxable at the federal level. And here's a key difference from TAI. This calculation does include capital gains of losses from selling assets.
So capital gains are back in the picture here for taxable income, even though they were allocated to principal for TAI purposes. That's important.
Yes, absolutely. That's a critical divergence. TAI is about what's distributable income according to the trust's rules. Taxable income is about what the IRS considers income, full stop. After you sum up the gross taxable income, you subtract the deductible expenses related to earning that taxable income. And sometimes expenses allocated to principal for TAI might still be deductible here for tax purposes.
Okay. What are the specific adjustments or rules the source points out when calculating this pre-distribution taxable income?
Well, first, pretty straightforward. Tax-exempt interest income is excluded. It's not taxed federally, so it doesn't go into the trust's gross taxable income calculation.
Makes sense.
But tied to that, the source highlights a really vital rule. Any expenses that were incurred to earn that tax-exempt income are not deductible.
Can't deduct costs for earning untaxed income.
Exactly. And to figure out how much of a general administrative expense, like our trustee fees, relates to the tax-exempt income, the source gives us a formula. You calculate a ratio, take the tax-exempt income and divide it by the total trust accounting income, TAI.
The $3 over the $10K in our example.
Right. That percentage, 30% in this case,
Yeah.
of the total expense, $6,000 fees, is deemed allocable to tax-exempt income and is therefore non-deductible for federal income tax purposes. This prevents the trust from getting a tax break for costs associated with earning income the IRS doesn't tax.
That makes perfect sense from the IRS's perspective. Okay, what else?
The source also mentions that trusts get a small statutory deduction called an exemption. It's just a fixed amount set by the tax code. It's $300 for simple trusts.
$300 for simple.
And it's $100 for complex trusts. It's just a little standard deduction they get.
Okay, so simple trusts get a slightly larger automatic deduction than complex ones. Interesting.
Right. So putting it all together, the source provides the basic calculation structure. Start with trust taxable gross income, make sure to include capital gains. Subtract the deductible trust expenses after removing the portion related to tax-exempt income. That gives you adjusted total income. Then subtract the appropriate exemption amount, $300 or $100. And the result is the trust taxable income before income distribution deduction.
Okay, let's apply this calculation to our Wells Trust using the numbers from example 2. Same facts. $3K tax-exempt interest, $5 taxable interest, $5K dividends, $10 capital gains, $6K trustee fees, and we know TAI was $10.
All right, first step, we need to figure out how much of that $6,000 trustee fee is not deductible because it relates to the $3,000 of tax-exempt income. We use that ratio. Tax-exempt income, $3,000 divided by TAI, $10,000.
3,000, 10,000, and we're 0.3 or 30%.
Right, so 30% of the total $6,000 trustee fee is non-deductible. 0.30, $6,000 $1,800.
$1,800 non-deductible. So the deductible portion of the trustee fees must be the total fees minus that non-deductible part, $6,000, $1,800 at $4,200.
Correct. $4,200 is deductible. Now we can calculate the trust taxable income before the income distribution deduction, assuming for now it's a simple trust. We take the taxable income items. $5,000 taxable interest plus $5,000 dividend income. That's $10,000.
Okay, $10K taxable ordinary income.
Then we add the capital gains plus $10,000.
So now we're at $20,000.
Right. Now subtract the deductible trustee fees. $4,200.
$20,000 for $1,200 and $15,800.
And finally, subtract the simple trust exemption, $300.
$15,800. $300 equals $15,500. So $15,500, that's the trust's potential taxable income before it gets any deduction for distributing income to Daniel.
Exactly, $15,500. And the source makes a quick note. If this same trust were classified as a complex trust for the year, the only difference in this specific calculation would be the exemption amount. It would use the $100 complex trust exemption instead of the $300 simple trust exemption.
So the complex trust's taxable income before the deduction would be slightly higher, $15,500 plus $300, $15,700.
Precisely. $15,700. Keep that number in mind, as it will be the starting point for our complex trust examples later. It just shows how that simple complex classification starts affecting the numbers right away, even if only slightly here.
Okay, so we have TAI, the book income, $10K in our example, which dictates the required distribution for a simple trust. We have the trust's taxable income before the income distribution deduction, $15.05K for simple, $15.07K for complex, which is the IRS's view of its income before distributions. Now, the source says we need this other really critical number, distributable net income, or DNI. What exactly is DNI and why is it so pivotal?
Yeah, DNI. You could argue it's the single most important concept in understanding non-grantor trust taxation.
The most important, okay.
The source defines DNI primarily as a crucial limitation. It acts as a ceiling, putting a cap on two very important things. First, it limits the amount of a trust distribution that a beneficiary has to include in their own taxable income.
Okay, limits beneficiary income.
And second, it limits the amount of the deduction that the trust itself can take for making those distributions, that income distribution deduction, or IDD we just mentioned.
So it's like the gatekeeper number. It controls how much income can effectively be shifted from the trust's tax return to the beneficiary's tax return. It caps how much tax liability gets pushed out.
That's an excellent way to think about it, yes. DNI represents the maximum amount of the trust's income for the year that can potentially be taxed to the beneficiaries. If a beneficiary receives distributions totaling more than the DNI amount, the excess is generally treated as a tax-free distribution of the trust's principal.
Wow. Okay, so DNI is the bridge connecting the trust's taxable world to the beneficiary's taxable world.
Exactly. It serves that linking function.
So how is DNI calculated? It sounds like it's related to that trust taxable income before IDD number we just figured out, $15.05K or $15.07K, but it's different somehow.
Yes, the source provides a reconciliation showing how to adjust that figure to arrive at DNI. DNI is built from the trust's taxable income base, but it includes and excludes certain specific items to arrive at this conceptual pool of income that's considered available for distribution for tax purposes.
What are the key differences? How do we adjust that previous number?
Okay, compared to the trust taxable income before IDD, here are the main adjustments to get to DNI. First, DNI reflects both taxable and non-taxable income components. So tax-exempt interest comes back into the calculation for DNI.
Tax-exempt is back in for DNI.
Second, you add back the trust's exemption, $300 or $100. The exemption is a tax deduction for the trust, not actual income available to distribute, so it gets added back to calculate this distributable pool.
Add back the exemption. Got it.
Third, you generally exclude net capital gains if they are allocated to principal for TAI purposes, which they were in our example.
Subtract the capital gains. Why?
Because capital gains that are part of the principal are typically not considered part of the regular annual income stream meant for current distribution to income beneficiaries. They're usually retained to grow the corpus, so they're removed from DNI.
Okay, subtract capital gains if allocated to corpus.
And finally, you have to account for those expenses related to the tax-exempt income. Remember the $1,800 non-deductible portion of the trustee fees. That amount reduces the tax-exempt income component within the DNI calculation.
So DNI brings back the tax-exempt income, takes out the exemption and capital gains if allocated to principal, and then specifically reduces the tax-exempt part by its related expenses.
You got it. The source lays out the formula structure, starting from that trust taxable income before income distribution deduction figure. You start with that number. You add back the exemption amount, the $300 or $100. You add back any capital losses allocated to corpus, although we didn't have any here. You subtract capital gains allocated to corpus, the $10,000 in our case. You add back the tax-exempt interest, the $3,000. And then you subtract the expenses allocated to that tax-exempt interest, the $1,800. The final result is distributable net income, DNI.
Okay, let's calculate DNI for the Wells Trust using the numbers from example 3, which uses the simple trust scenario. Our starting point, the trust taxable income before IDD for the simple trust, was $15,500.
Right, $15,500.
The simple trust exemption was $300. The capital gains allocated to corpus were $10,000. The tax-exempt interest was $3,000. And we calculated that $1,800 of the trustee fees were allocable to that tax-exempt interest.
Okay, let's plug those into the DNI formula. Start with trust taxable income before IDD, $15,500. Add back the simple trust exemption, plus $300. Subtract capital gains allocated to corpus, $10,000. Add back tax-exempt interest, plus $3,000. Subtract expenses allocated to tax-exempt interest.
$1,800.
Okay, let's do the math. $15,500 plus $300 is $15,800. Minus $10,000 is $15,000 plus $3,800 equals $7,000. So the distributable net income DNI for the Wells Trust in this year is $7,000.
$7,000 is the magic DNI number for this trust this year, and this $7,000 is what will act as that critical limitation we talked about, capping both the income tax to the beneficiary and the deduction the trust can take.
Got it. DNI suggests $7,000. And the source makes another interesting point in example 3. It recalculates DNI, assuming it was a complex trust. Remember, the complex trust's starting taxable income before IDD was slightly higher, $15,700, and its exemption was smaller, $100.
Right.
If you run the DNI calculation starting with $15,700, add back the $100 complex exemption, and then make the same adjustments for capital gains, $10, tax-exempt interest plus $3K, and related expenses, $1 8K, you get $15,700 plus $100, $10,000 plus $3,000, $1,800.
Let's see, $15,800, $10,000 is $5,800 plus
Yeah.
$3,000 is $1,800. It's still $7,000.
Exactly. The DNI is the same, $7,000 in this specific example. Whether the trust is simple or complex, this really demonstrates that DNI isn't just a direct pass-through of the trust's taxable income. It's its own specially calculated figure, following its own rules, designed to serve that specific limiting purpose. The inputs change slightly, but the resulting DNI happen to be the same here.
That's fascinating. Okay, so we've established that the pool of income potentially taxable to the beneficiary is limited by this DNI figure, which is $7,000 in our running Wells Trust example. Now, the big question, how does that limit actually apply to you, the beneficiary, when you get a distribution check from the trust? How much of that money is actually taxable income on your return?
Right, this is where DNI's power as a limitation really comes into play for the beneficiary. The source states the fundamental rule very clearly. You, as the beneficiary, only include the distributions you receive from the trust in your own taxable income up to the amount of the trust's distributable net income, DNI, for that year.
Ah, so DNI really is a cap. Even if the trust physically hands me, say, $10,000 in cash, if the trust's DNI for the year was only $7,000, then only $7,000 of that $10,000 is potentially considered taxable income to me.
Precisely. If you receive more cash than the trust's DNI, the amount that exceeds DNI is generally treated as a tax-free distribution of trust principal. It's just getting some of the original capital back, not income.
Okay, that's a huge concept. DNI as the ceiling for beneficiary taxation. What else do we need to know?
The source also emphasizes something called the character rule.
Character rule.
Yes. This means that the type or character of the income earned by the trust retains that same character when it passes through to the beneficiary via distribution, up to the DNI limit.
So if the trust earned, say, dividend income and tax-exempt interest,
Then the distribution you receive is treated as being made up proportionally of those same types of income.
Yep.
Some dividend income, some tax-exempt interest.
then why does that matter?
It matters a lot because different types of income are taxed differently on your personal tax return. Qualified dividends might be taxed at lower rates than ordinary interest. Tax-exempt interest isn't taxed federally at all. So knowing the character of the income included in your distribution is crucial for figuring out your actual tax liability. The K-1 form breaks this down for you.
Okay, let's put this together with the simple trust first, using example 4 and our Wells Trust facts. It's a simple trust. TAI was $10,000. DNI we calculated as $7,000. Daniel is the beneficiary. Now, because it's a simple trust, the trust agreement required it to distribute that full $10,000 of TAI to Daniel, so Daniel got a check for $10,000.
Correct. Now we apply the rule for a simple trust beneficiary. They must include the amount of income the trust was required to distribute, $10,000 in this case,
Okay.
in their own income, but only up to the trust D&I limit, $7,000.
Okay, so the required distribution was $10. The DNI limit is $7K. The beneficiary includes the lesser of those two amounts. So even though Daniel received $10,000 in cash, his total income from the trust for tax purposes is limited to the DNI amount, which is $7,000.
Exactly. Daniel's reportable income from the trust is $7,000. Now, the next step is to determine the character of that $7,000. How much is dividends? How much is taxable interest? How much is tax exempt?
Right, the character rule, how is that $7,000 allocated?
It's allocated proportionally based on the different types of income that made up the D&I, after taking into account any related expenses that reduce those income types within the D&I calculation. Remember how we calculated D&I?
Vaguely. It involved adding back tax-exempt income and subtracting related expenses.
Right. If we look back at the components of the $7,000 D&I, implicitly from the example 3 calculation, it was made up of the $5K taxable interest plus $5K dividends minus the $4,200 deductible fees plus the $3K tax-exempt interest minus the $1,800 non-deductible fees.
Okay, so $10K ordinary income minus $4 2K fees is $5, $8K taxable component, and $3K tax exempt minus $1 8K fees is $1 8K pays plus $1 8K plus $1 7K DNI. That matches.
Exactly. So the $7,000 D&I consists of $5,800 of taxable items, originally $5K interest, $5K dividends, and $1,200 of tax-exempt interest, originally $30K. Now we need to allocate that $7,000 income reported by Daniel.
How are the fees allocated between taxable interest and dividends in the example's solution? It showed $2,900 dividend income and $2,900 taxable interest for Daniel.
Good question. The source's example 4 solution implicitly allocates the $4,200 deductible trustee fees equally between the $5,000 taxable interest and the $5,000 dividends. So $2,100 of fees against taxable interest leaves $2,900, $5K, $2 1K. And $2,100 of fees against dividends leaves $2,900, $5K is $2 1K.
Okay, so the $5,800 taxable portion of DNI is $2,900 taxable interest and $2,900 dividends, and the tax-exempt portion.
That was the original $3,000 tax-exempt interest reduced by the $1,800 of fees allocated to it because they were non-deductible. $3,800 equals a $1,200 net tax-exempt income in DNI.
So Daniel's $7,000 of total trust income limited by DNI is characterized as $2,900 of dividend income, $2,900 of taxable interest income, and $1,200 of tax-exempt interest income. Does that add up? $2.09K plus $2.09K plus $1 for 2K, $7.
Perfect. So when Daniel files his personal tax return, what's the taxable amount he reports from this trust?
It would be the sum of the taxable types. $2,900 dividends plus $2,900 taxable interest equals $5,800.
Correct. $5,800 is his taxable income from the trust. The $1,200 of tax-exempt interest income he received isn't subject to federal income tax, but it was still part of his total $7,000 trust distribution that used up the DNI. The $7,000 total, with the breakdown by character, is what the trust will report to him on that Schedule K1.
Okay, that makes sense for the simple trust. Now let's contrast that with the complex trust beneficiary scenario using example 5. We're using the same original facts for the Wells Trust, but let's assume for this year it's operating as a complex trust. Maybe the trust document allows principal distributions, making it complex. We know it's trust taxable income. Before IDD was $15,700 using the $100 complex exemption, and we found out the DNI was still $7,000 in this specific example.
Right.
But here's the twist in example 5. In this complex trust scenario, the trustee made a discretionary distribution of only $5,000 to Daniel, not the full $10 KTAI.
And this is where that key difference between simple and complex really hits the beneficiary's tax simulation. For a complex trust beneficiary, the source explains they must include the amount of the actual distribution received, $5,000 in this case, in their income, but still limited by the DNI cap, $7,000.
Okay, so Daniel actually received $5,000 cash. The DNI was $7,000. We compare the actual distribution, $5K, to the DNI, $7K. The beneficiary includes the lesser of those two amounts and their total income from the trust. The lesser amount here is $5,000.
Correct. So Daniel's total reportable income from the complex trust for tax purposes is $5,000. Notice here, the DNI, 7K, didn't actually limit the amount he reported this time because the distribution, $5K, was smaller than DNI. But DNI would have capped it if the trustee had distributed to, say, $8,000. He still would have only reported $7,000.
Got it. So he reports $5,000 total. Now, how is that $5,000 distribution characterized? Does the character rule still apply?
Yes, absolutely. Just like with the simple trust, the $5,000 distribution is allocated proportionally based on the mix of income types within the DNI pool. The DNI pool itself hasn't changed. It's still that $7,000 total made up of $2,900 net dividends, $2,900 net taxable interest, and $1,200 net tax-exempt interest, all after those allocated expenses.
Okay, so Daniel's $5,000 distribution is treated as pulling from that $7,000 DNI pool proportionally. We need the percentages of each income type within DNI again.
Right, based on the $7,000 DNI. Net dividends, $2,900 or $2,907,000, which is approximately 41.4% of DNI. Net taxable interest is also $2,900, $7,000, approximately 41.4% of DNI. Net tax-exempt interest, $1,200, $7,000, approximately 17.2% of DNI. Those percentages add up to 100%.
Okay, got the percentages. Now we apply those percentages to the actual distribution Daniel received, which was $5,000.
Exactly. To determine the composition of his $5,000 distribution, it includes dividend income of 41.4%, $5,000, $2,070 approx. It includes taxable interest income of 41.4% of $5,000, $2,070 approx. It includes tax-exempt interest income of 17.2%, $5,000, $860 approx.
Let's check the total. $2,070 plus $2,070 plus $860 equals $5,000. Perfect. It matches the distribution. So what is Daniel's final taxable income from this complex trust distribution?
It's for the taxable parts. $2,070 dividends plus $2,070 taxable interest for $4,140.
$4,140 taxable. And his total income from the distribution, taxable plus non-taxable, is $4,140 plus $860 equals $5,000, which matches the actual cash he received.
You got it. That clearly illustrates the key difference in how beneficiaries are taxed depending on the trust type. For a simple trust, the beneficiary is taxed on the income required to be distributed, the TAI, but capped at the DNI limit.
Yeah.
For a complex trust, the beneficiary is taxed on the actual distribution received, again capped at the DNI limit.
So DNI is the absolute ceiling in both cases, but the starting point required income versus actual distribution depends on whether the trust is simple or complex for that year.
Precisely. And that's why understanding that simple complex classification, which can change year to year, is so fundamental. It directly impacts the beneficiary's K-1.
Okay, fantastic. We've seen how DNI acts as a cap on the beneficiary's taxable income. Now let's flip back to the trust itself. How does the amount that got taxed to the beneficiary affect the trust's own final tax bill? This is where that income distribution deduction, IDD, comes in, right?
Exactly. The whole purpose of the income distribution deduction, or IDD, is really straightforward.
Yeah.
It's there to prevent double taxation.
Double taxation, okay.
It allows the non-grantor trust to deduct the income that is being passed through and taxed to the beneficiaries. This deduction effectively shifts that income off the trust's tax return, Form 1041, and onto the beneficiary's tax return, Form 1040, ensuring that the same dollar of income isn't taxed twice, once at the trust level and again at the beneficiary level.
So basically, whatever taxable income the beneficiary has to report from the trust gets a corresponding deduction for that same amount.
That's the core idea, yes. The source technically states the rule for the deduction amount is the lesser of the actual income distributions made, or required to be made, or the trust's DNI. But then it's further limited because you can only deduct the portion that represents taxable income included in the DNI passed out. So, in practice, it generally lines up very closely with the amount of taxable income the beneficiary actually includes on their return due to the distribution.
Okay, so the source gives us the final step now for calculating the trust's actual taxable income for the year.
Yes. We take that intermediate figure we calculated earlier, the trust's taxable income before income distribution deduction. And from that, we subtract this income distribution deduction, IDD.
The final formula looks like trust taxable income before IDD from Section 5 minus the income distribution deduction, the amount taxed to the beneficiary, equals the final trust taxable income, the amount the trust itself pays tax on.
That's the final calculation.
All right, let's wrap up our Wells Trust examples by seeing these final trust tax numbers. Example 6 looks at the simple trust scenario again. We calculated its trust taxable income before IDD was $15,500, and we just figured out that Daniel's taxable income from the simple trust distribution, which was capped by DNI, was $5,800.
Right. So the simple trust gets an income distribution deduction, IDD, equal to the taxable amount passed to Daniel, $5,800. The final trust taxable income is therefore $15,500 before IDD minus the $5,800 IDD.
$15,500, $500, $9,700. So $9,700 is the taxable income that remains inside the simple trust, and the trust will pay tax on this amount at trust tax rates, which, by the way, tend to be compressed, meaning higher rates kick in at lower income levels than for individuals.
Exactly, $9,700 tax to the trust. And here the source makes that really insightful observation again in the notes for example 6. It points out that this $9,700 result for the simple trust is exactly equal to the trust's $10,000 capital gain minus its $300 simple trust exemption. $10,300 and $9,700.
Why does that happen? Is that just a coincidence here?
It's not a coincidence in this typical simple trust scenario, because the simple trust had to distribute all its TAI, which included the ordinary income like interest and dividends, and that distribution was limited by DNI. Essentially, all the taxable ordinary income within DNI, $5,800 in this case, got pushed out to the beneficiary via the IDD. What's left behind in the trust to be taxed? Primarily the capital gains, $10,000, which were allocated to principal and generally aren't part of DNI, minus the trust's own exemption, $300.
So for a simple trust like this, the ordinary income tax burden essentially follows the beneficiary up to DNI, and the capital gains tax burden stays with the trust.
Precisely, assuming those standard allocation rules apply and capital gains aren't defined as income in the trust document or required to be distributed. It creates a relatively clean split of who pays tax on what type of income.
Okay, that makes sense. Now, finally, let's look at the complex trust scenario in example 7. Its trust taxable income before IDD was $15,700, using the $100 complex exemption. And we found that Daniel's taxable income from the $5,000 actual distribution was $4,140 because only the taxable portion counts, and the total was less than DNI anyway.
Right. So the complex trust gets an income distribution deduction, IDD, equal to the taxable amount passed to Daniel, $4,140. The final trust taxable income for the complex trust is $15,700 before IDD, minus the $4,140 IDD.
$15,700, $4,160, so $11,560 is the taxable income remaining inside the complex trust to be taxed at trust rates.
Correct. Now, compare that $11,560 for the complex trust to the $9,700 we got for the simple trust.
The complex trust has higher taxable income left over.
Exactly. And why? Because it only distributed $5,000 when it's DNI. The pool of distributable income was $7,000. It didn't push out all of that available ordinary income equivalent to the beneficiary like the simple trust was required to.
So it retains some of that ordinary income potential.
Effectively, yes. So the trust ends up being taxed on the $10,000 capital gain plus the portion of DNI that wasn't distributed and taxed to the beneficiary. Conceptually, the difference between the $5,800 taxable DNI component and the $4,140 actually taxed to Daniel, which is $1,660, minus its smaller $100 complex exemption. $10,000 plus $1,660, $100 it feels, $11,560. It matches. The flexibility of the complex trust to accumulate income or make smaller distributions means more of the tax burden can potentially remain with the trust compared to a simple trust.
Wow. Okay. We have really followed well, not the money itself, but the tax liability all the way through the trust structure. It's quite a journey.
It is.
From understanding the basic players, grantor, trustee, beneficiary, and the definitions, then classifying trusts as grantor or non-grantor,
Right.
then non-grantor trusts into simple or complex, which affects distributions,
Right.
and calculating these different specific income figures. TAI, book income, trust taxable income before IDD, the IRS starting point including capital gains, and the absolutely critical DNI, the bridge and the limit.
DNI is key.
Then seeing exactly how DNI caps what the beneficiary is taxed on while keeping the income's character.
The character rule, yes.
And finally, how the trust gets that income distribution deduction for the taxable amount passed to the beneficiary, leaving the rest to be taxed inside the trust. It all connects.
It really does. It's a logical flow once you understand the pieces. To quickly recap that essential journey for non-grantor trusts, based on our source, they are separate taxpayers. Their classification as simple or complex dictates distribution rules, mandatory TAI distribution versus discretionary. TAI is that internal book income. Trust taxable income before deduction is the IRS's starting point, including capital gains. DNI is that crucial statutory number, the bridge and the ceiling. Beneficiaries are taxed on distributions, but only up to DNI, and the income keeps its character. The trust then deducts the taxable income passed to beneficiaries, avoiding double tax. What's left is taxed to the trust.
Okay, so after walking through all of that detail, why should this really matter to you, the listener? What's the practical takeaway?
Well, if you are currently a beneficiary of a trust, or maybe you expect to be one in the future, understanding these mechanics is really powerful. It helps you make sense of that Schedule K-1 form you receive each year.
Right, the K-1.
It explains why a certain amount is reported to you as taxable income. You now know it's tied to the trust's D&I calculation and the amount distributed to you. You'll understand that getting a large check from the trust, maybe from principal, might not actually be taxable income if it exceeds the D&I for the year. You'll also understand why the income types, dividends, interest, etc., are broken out separately on the K-1. It's because their character matters for your personal tax return.
That makes sense. It demystifies the K-1. What about if you're on the other side, maybe involved in setting up or managing a trust?
Then understanding this is even more critical. Knowing the difference between simple and complex trust rules, understanding how TAI and DNI are calculated, and seeing how distribution decisions directly impact the tax liability for both the trust and the beneficiaries is absolutely fundamental. It informs everything from distribution strategies year to year to how the trust document itself might be drafted to try and achieve certain tax outcomes for the beneficiaries down the line.
So it's not just about managing the investments, it's about managing the tax implications proactively.
Exactly. It really underscores that planning for and managing a non-grantor trust involve actively navigating these very specific tax rules. Rules around income characterization, the proper allocation of expenses, the D&I limitation concept, and that income distribution deduction. It's not just about asset management. It's deeply intertwined with tax management for the benefit of everyone involved.
That really brings the complexity down to earth, seeing the practical consequences.
Thinking about the examples, this raises an important question, or maybe just a final observation to leave people with.
Yeah.
We saw repeatedly how expenses, particularly those trustee fees, had to be allocated based on different rules at different stages. First, they were split between principal and TAI based on the trust agreement for calculating TAI.
Right, the 50-50 split.
Then, for tax purposes, those same fees had to be allocated again, this time between taxable and tax-exempt income, using that ratio based on TAI to figure out the deductible amount for the trust and also to correctly calculate D&I and its components. This allocation process for just one expense item rippled through everything. It affected TAI, it affected the trust's deductible expenses, it affected the D&I calculation itself, and ultimately it affected the character and amount of income that was taxed to Daniel, the beneficiary, and the amount left taxed to the trust.
That's a great point. It shows how incredibly interconnected all these calculations are.
It really does. It highlights how even a seemingly small detail, like how administrative expenses are allocated according to the trust document or state law, can have significant downstream effects throughout the entire, quite complex trust tax calculation process. It impacts the tax bill for both the trust and the beneficiary. It's a reminder that in trust taxation, the details really, really matter.
That's a fantastic point to end on. It really underscores the intricate nature of this, but also why understanding the mechanics is so valuable. Thank you so much for walking us through that, and thank you for joining us for this deep dive into the world of trust taxation. We genuinely hope this breakdown has helped illuminate these important concepts and left you feeling more informed about how trusts and their beneficiaries navigate the tax system.